All right, guys, we are going to do some products today. This is a very, very exciting stuff. I know a lot of you guys sell a lot of life insurance, a lot of you guys sell a lot of investments. Today, we're going to be talking about annuity products, but we're going to be talking about them in the context of our planning process. So, I'm not going to be going over a whole lot of specific product detail, but I'm going to talk to you a little bit about how to place these different products in different scenarios. And also in the context of how we do our allocation. So, a lot of you guys are securities licensed out there. A lot of you are not. For those of you guys that whatever platform you use is fine. I'm just going to talk a little bit about the platform that we use and why the allocations really work out so nicely. And try to keep it really high level and simple so you guys can talk to your clients about this similar idea. Okay? So I think everybody knows that the general mantra out there is, hey, you can invest in something with stock market type returns without the risk. If the market crashes, there's a guarantee of principal. We can, there's investment options. I think some people will sell, the safe money solution. So like, the annuities or like the fixed portion of the portfolio. Whatever it is that you do, that's totally fine. That's not really an issue for our planning process. What I really like to do, though, is talk to people about the allocations. So most people are looking at asset allocations with stocks, bonds, and mutual funds, right? So historically, you've heard of 70-30 allocations, 50-50 allocations, 60-40 where 60% is stocks, 40% is bonds. That's what most people are aware of. And, pretty much, even normal everyday people have heard of these sort of asset allocations. They don't necessarily know what they mean. And actually what they mean isn't really that important. But the idea is that they've heard of these allocations. So when we're talking to our clients about allocations, what we're going to do is we're going to try to make drastic improvements for them, right? And in order for them to make drastic improvements, we have to understand where they are. So let's take a really simple example. Let's say somebody has a 50-50 allocation, right? That 50-50 allocation may be 50% stocks/mutual funds and then 50% bonds. Okay? So let's start off with the stocks/mutual funds, right? So let's take a look at their stuff. And what you're going to see when you look at their portfolios is you will see mutual funds with Fidelity or Vanguard or Edward Jones or whatever, and you're going to see a mishmash of stuff, and it's not going to make any sense at all, right? If they are fortunate enough, which may be like 1% of people, like literally 1%, 1 out of 100, will have a private money manager that's doing a really great job managing their assets, right? So we do private wealth management within our organization, and the guys that we use do a fantastic job, right? But most people do not have a guy that's doing private wealth management. So their 50% that's in equities is usually just in mutual funds or some BS mishmash of whatever, right? So starting point number one, compare their stuff to the S&P 500 index. Compare it fee-wise if you're not securities licensed. If you are securities licensed, compare it performance-wise, right? But do some type of comparison to the benchmark. That benchmark is really, really important. It is the foundation of how we are able to position problems versus solutions through our process. And obviously, all you guys remember, the main indexes that we talk about are the S&P 500. Sometimes we'll use the Dow. If they're technology driven, you could use the NASDAQ. If they're small company driven, you could use the Russell. If they're internationally driven, which there's not very many people that are, but you can use the MFCI, whatever, LIBOR, whatever, international index you want to use. But we're always comparing things to the indexes. And in comparing things to the indexes, what we're going to find is on the equity portion, guys, we're just talking about the stock mutual fund portion, the 50%. In the equity portion of their lives, they are usually paying a higher fee and performing worse than the index, right? Almost every time. So if you can have the conversation with them, and in fact, I'm going to go right here. And I had a client ask me the other day, and when I had said to them, did you know that most people perform worse than the market? Let's just do indexes versus mutual funds. Indexes versus mutual funds. When you Google this, and by the way, a target date 2030 is a mutual fund. Okay, guys? A bond portfolio is a mutual fund. A stock portfolio is a mutual fund. Very, very seldom does somebody have just individual stocks. Most of the time they have mutual funds or indexes or some combination, okay? So when we look at, indexes versus mutual funds, there's a ton of articles that people can read. But what they're going to find is a whole page worth of articles here. They're going to find that in general, indexes tend to do better and cost less than whatever style of investments they have, right? So indexes versus mutual funds, whatever. There's some. Here's a Yahoo Finance one. Good reading for people if they're really interested. If they're not interested, then you can just have a conversation with them. So if indexes tend to do better than mutual funds, that's a great starting point of knowledge, right? And then what we can tell people is, we actually have some calculators, and that's why I had this calculator up, our random return calculator. We have some calculators that sort of measure the most efficient and most practical way to own indexes, right? So you have this S&P 500 that's done gangbusters, and $1 million in 2000 would have had a massive roller coaster ride, all the way down to 500, back up to million, up to 1.7 million. This has been a wild ride, and everybody knows about it. So, and this wild ride is totally fine. There's nothing wrong with it as long as people don't need their money. And that's the conversation I like to have. When you're investing in equities, as long as you don't need the money, it's perfectly fine because you're going to have this wild roller coaster ride. Now, in our wealth management platform, I'll pull it up for you guys. We do individual stock portfolios, and our individual stock portfolios look like this. And again, just in our portfolio, what we're going to see is a comparison to the benchmark, right? So this is ours. You don't have to use this, but just this is how we position it. If the S&P 500 is the benchmark and our minimum portfolio value is 250, right? Rather than owning hundreds of stocks like you have in your mutual fund, target fund, or whatever you're doing, some people have 15 mutual funds for God knows what reason. Our wealth management platform holds 21 stocks. And more important than that is that when you look at the portfolio return versus the benchmark, consistently, we have been able to outpace the S&P 500 by about 7% per year. So a 3-year, 5-year, 10-year edge. Of course, this is not necessarily true about the future because the market's been incredibly great, but benchmark S&P, 10-year average 13, private wealth management portfolio return 21%, outpaced by 7%, 5-year outpaced by 7%, 3-year outpaced by 7%. It's a very consistent story. So if you are securities licensed and you have the ability to do a private wealth platform, and we can have some money managed like this that can be compared to the benchmark favorably, that's a great foot up, a great leg up, and an easy thing to talk about. If you're not securities licensed, though, and you don't have these private wealth platforms, that's what these calculators are for, right? So you're comparing the S&P 500. What does the equity index button do? Is it compares it to an index that is volatility controlled. And we'll talk about 3 or 4 of them today. But what the volatility controlled index does, as you can tell the client, volatility control simply means that it's going to really smooth out your risk over time, and you're never going to have any risk to principal. So in our calculator, volatility control is going to show the negatives as zeros, and it's going to cut all the positive returns in half. Now, some of our volatility controls actually do much better than what I'm showing. Okay, they give you more than this, and they've done better than this, but I think this is a great starting point to see when you have negatives that are zeros and you have more modest returns, it's actually a much smoother ride at the end of the day. So which column would you prefer? You don't have to have a securities license to talk about volatility controlled indexes, right? So this can be a very simple conversation. We're not giving them a solution yet, right? We're identifying the massive roller coaster people have been on and saying, hey, which one would you prefer? Now, here's the real game changer, right? You have more money in this scenario, which is great. 500 grand more with less risk kind of sounds like a no-brainer, right? We know the power of the random returns of this calculator. I'm not going to talk about that today, honestly, right? I'm just going to do one thing only. Take a withdrawal. So if you take a 5% withdrawal, right, this is where it's a little bit of a game changer. If you take a 5% withdrawal from your index fund or your investment portfolio, because you don't control volatility, we don't know what's going to happen in the market over this 20-year period of time, which is, the bulk of somebody's retirement life, they could potentially run out of money. In this side, with basically no risk, pure protection of principal, they can have their cake and eat it too. They can take out this $50,000, the exact same withdrawal, and at the end of the period of time, they have $780,000 left over. So the bulk, over 75% of all their money is still there. Again, which column would you prefer? So soft conversation, educational, not selling anything, okay? This stuff is going to sell itself. All right. This is the equity conversation, right? I didn't even talk about the other portion yet, right? We're comparing volatility controlled indexes versus S&P indexes. We already know S&P indexes tend to do better and cost less than everything else. But we've got something here that can be favorably compared, but with much less risk and volatility than an S&P index, which is really the flagship index, right? Now, the second half of their portfolio is going to be in bonds, right? Or it's going to be in cash, or it's going to be in whatever, right? So for those who are securities licensed, you can talk about the bond portfolios. You can talk to them about risk versus return. You can talk to them about standard deviations, alphas, betas, whatever you want to talk to them, doesn't matter. But the best conversation to have about bonds is this. Why on earth would you be investing in bonds in the current interest rate environment that we're at? And almost every bond that somebody has, or almost every bond portfolio, has been pretty much non-performing. And I think people will know that. And you can ask them, say, hey, what has your bond portfolio been returning? 1%, 2%, maybe 3%, probably not over the last decade, right? If they've got a fantastic, stellar, unbelievable one, they've been getting 4 or 5, but not very likely. But more important than that is bonds and their prices are directly, inversely related to interest rates. What that means, if you guys don't know it, is as interest rates goes up, bond prices go down. Where are interest rates going to be going? So if interest rates are going up, bond prices don't look too favorable. What are your alternatives to your bonds? Right? What are your alternatives? Well, we actually have these things for the safe money, for the fixed portions. We can help manage your more conservative position, your other 50%, in something called a volatility controlled indexes. The way that these work is that they're tied to different indices. Many of them, by the way, have no fees at all. And these indices are protected in case the market doesn't do well. You can never lose any principal, but they tend to do much, much better than a fixed money market, CD, or bond type of position. Let me show you how those work. So for the other, imagine guys, if you can lift up and increase or enhance the equity portion, but then you can really blow doors on their safe money conservative portion on the other 50%, right? So for people that are fee sensitive, I'll show you guys F&G, and I'll show you guys Delaware Life, right? If you're fee sensitive, this is the F&G Barclays Trailblazers. I guess a lot of you guys have seen this. There's no fee in here at all, right? It is a portfolio of ETFs, right? What are ETFs? They're like indexes, but they trade every day. See the word ETF for spider? You can look up, your clients can look up any of these symbols. So I just literally just give them, see what says no caps, no limits? I just give them the brochure. and they can look all this stuff up at their leisure. Say, look, just going to put together a really simplified portfolio for you here. All ETFs are spiders, no fees, no caps, no limits, right? We're not trying to get 10 or 20%. We're just trying to get a consistent, 4, 5, 6 would be fantastic, right? But in order to do this, we need to make sure you don't lose any money. That's what this Volatility Control Index does. It helps make sure you don't lose any money. Okay, so this is the Barclays Index brochure. Send it out to a client. Here's my illustration just so you guys can see this. $500,000 example, most recent, the low and the high. So the worst 10 years that it has done, historically speaking, the worst 10 years obviously included 2008 and 9 in here. There's going to be a bunch of years where there's zeros. All right, and there's going to be some years where they're really positive. And this is a 2-year reset, right? So this is a 2-year, 25% was, they made 12.5% each year for 2 years, 9% for 2 years, 4.5%, 2.5%, right? And then zeros. Well, lo and behold, that 10-year average is a nice round 5.5%. That's the worst, guys. That's the low. The high and the most recent are the same. So that started right after the market crash of 2009, right? Right after the market crash 2009, the first year, no interest credited, then 25, no interest credited 18, no interest credited 9, no interest credited 24, no interest credited. So it only credits every other year. Pretty simple, right? So your clients shouldn't freak out if they don't get interest every year, right? Because they're going to get credited every 2 years. Not too bad in our sweet spot, right? 8.2%. No cap, no fee, right? 8.2%. So if our bookends are 5.5 to 8.2, compare that to their fixed money, to their safe money, to their bond portfolio. This really should blow doors for them. Okay. The nice thing about these two that I'm going to show you is that they are flexible premium, meaning you can add money to it. Very suitable for Roth accounts, for contributory accounts, very suitable for that. So they're flexible premium, you can add money to it. Compare this one with the Delaware one. So the Barclays one is all US. US, 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 US. That's fine. If you want to diversify somebody into something that is outside the US, global index, Germany, Japan, energy, ag, precious metals, right? MSGO. MSGO is truly contrarian. It's going to do something very different than the market. This is one of the car in every lane ideas because look what happened. So, this is not going to follow the U.S. stock market. Just like everything else they have is going to follow the U.S. stock market. This is a great way to diversify outside of just having so much in the U.S. domestic market. So right now people are so heavily weighted in U.S. domestic. When that market comes back and tanks, it is going to crush them. They're going to lose money everywhere. Let's have something that will help complement or supplement what they're already doing. And that's why I really like this. Okay? So in this particular case, we'll go back to the really terrible years and the really good years. So in the good years, we're not going to get 20% returns. We're going to get 6s and 9s and 3s, right? But in the bad years, like 2008, rather than going negative 30 whatever, you get a positive 9. People will like this because, again, it's a great complement or supplement to other stuff. Got a 12-year trailing average of almost 7%. That's right in our sweet spot for safe money. Again, we're probably illustrating 4 or 5 for our safe money. If they get 6, that's even better, but we don't need it. So these are easy sells, easy positions. Again, another flexible premium product. And you guys, for those of you who know this, you can have different investments within these same index accounts and within these same index annuities. You don't just have to pick one, right? You can pick multiple, but let's just start them out with one and see how they do. Okay, so these are two of the flexible premium, really easy ones to do. Pretty simple, right? Okay. So if people are not fee sensitive, if they just want to make as much money as possible, so you have to gauge that yourself. That's a little bit of the whole of you getting to know the client, right? If they just want to make more money and they're not as fee sensitive, then we would go into things like Shiller indexes and more aggressive stuff, right? So we have some really, really great Shiller indexes. By the way, these Shiller indexes are changing. They've all changed. So don't just take this with a grain of salt right now, guys. But if we have really good volatility controlled indexes in good years, they're easily able to earn 10% or more easily, right? And we have Nobel Prize winning indexes. We have online access so they can see their accounts changing every day. We have no wait for withdrawal, right? So you can put in 500 grand, take money out tomorrow, no problem, right? So there's different features and benefits. Okay, this particular Shiller type index, we like it because there's no waiting period for withdrawal. We also like it because he's a Nobel Prize winning financial guy. We have great white papers, lots of supporting documents. It's fantastic, simple to use. But just like every other annuity, they're almost across the board, they're very, very similar, right? 10% a year is the free withdrawal amount. Don't have to get too complicated with this type of stuff. This particular one is not suitable for flexible premiums, meaning you can't add money, right? So I use these types of indexes and these volatility controlled annuities in my CRUTs because the CRUTs we need to take money out right away. Some of the other ones, by the way, you can also take money out right away, not all of them. But I like to throw money in, take money out right away, know that that income has a high chance of never running out if they only need 5%, which makes sense, and all that kind of good stuff. So I can go over more specific stuff with you guys, and I will in the future, but you'll notice we had a much longer conversation on the front end, used a little bit of the calculators, and now think about what the overall game plan here is, guys. Private money management, right, for the 50%. Compared to the index, we're going to crush. Really, really personalized. We charge a fee for that, obviously, like everybody else does, but our fee is probably a little bit less, or you can charge whatever you want. It doesn't matter. And then for the fixed portion, we're going to go into volatility-controlled indexes, and we have a plethora to choose from, earning between 5 and 10%. There's a lot of other things. By the way, let me show you another one. I'm going to show you another one, and the only reason I'm showing you guys this is because I love the fact, and I'm not going to get into specific product detail today, but look at this. I love the fact, I'm going to make this really, really big. We have volatility-controlled indexes where they're not showing us the best years. We have volatility-controlled indexes that show us what would have happened if you invested at the worst possible time. So if you invested in 2000 and the market tanked, we have volatility-controlled indexes that still averaged over 5% starting at the worst possible time in the market because they didn't have to do any recovery because they never went down. We love that versus the bonds, versus the T-bills, versus the money markets. It's an easy conversation to have, guys, right? So we are drastically going to enhance their safe money. We're going to keep their other money liquid, right? And we're going to invest it in whatever we need to do. But these I use the term volatility-controlled indexes. I use the term equity index annuities. I use these terms because people are going to go look them up, and they'll see all these different things, and they'll get very confused. We have to keep it simple. Our job is to keep it simple. The simpler we keep it, the more comfortable we feel. If you start getting into details about, internal mechanisms of this, that, and the other, it is going to turn a lot of people off because they're going to say, if I don't understand it, I won't invest in it. Okay? So our job is to help people understand how these things work and not overcomplicate it. I would literally take 90% of what most people will say, just throw it out the window and just focus on the 10%. All right? And then people will be very comfortable because these things, they do what they're supposed to do, guys. They protect you from the downside, and they earn reasonable returns when the market's well. Doesn't have to be more complicated than that. Okay? So you can do a lot more selling with conversations and calculators than you can do, here's my cool equity index versus S&P, right? Good years, bad years, whatever, depending upon what period of time. It's an awesome thing, guys. We're not trying to beat the S&P. We're trying to have returns that are linked to an index without the downside volatility or risk. People will always say, not going to always say it, honestly, they're always going to ask you, this is too good to be true. Right? The answer is this. Well, you know what? A lot of people say that's, but here's the deal. They want you to hold your money with them for a certain period of time. Because if they know that they're going to have your money in their coffers for a certain period of time, that they're going to take your money and leverage and do other things. And that's how we know they make money, right? So they limit your withdrawals to 10% per year. That's the string that's attached. They limit your withdrawals. Sometimes it's 7% a year, 5%, 10%. But by limiting your withdrawals to a certain amount per year, they know that they are always going to be holding on to a significant portion of your money. They can leverage, they can arbitrage, they can do all the other things. Let's leave that to them, and let's take their wrapper of protection and take that for what it's worth. Right? I also like to tell people, guess when people flock to these accounts more than any other time ever? People don't flock. It's just this human nature. It's like the worst possible time, right? Human nature tells us we don't sell when we're making money. Human nature tells us, this is a fine conversation to have if your client wants to have it. Don't go into this details, guys, if people don't want to have it. If the client's not really engaged in this conversation, don't just keep vomiting from the mouth for no reason. But just, you can engage them if they're really curious about how these guys make their money, why it's not too good to be true, right? When you're at $1 million, are people selling and moving to volatility controlled indexes? Absolutely not. When you're at 600 and you just took the market crash in the shorts, are you freaking out and selling and buying volatility controlled indexes? Absolutely. So the way that like human psychology works, and insurance companies, annuity companies, everybody, they capitalize on this stuff. It's not rocket science. They get massive, massive influxes of money after the American public has taken it on the shorts and lost money. Then you go into a principally protected account with a 600, right? The consumer loss in that scenario. And these guys, when the market comes back up and recovers, they'll recover your money, but they're going to now make money with you. They'll partner with you. It's a great deal for them. Does that make sense? So in our world, when would be the most perfect time to reposition some of our money and volatility controlled indexes? At this million mark, and God forbid, at this $1.7 million mark. This is the time. This is the opportunity in front of us. It is unbelievable how important it is right now to have some of your clients miss the next market correction with some of their life savings. That is your sale. How much of your life savings would you like to miss the next market correction? Let me help steer you towards a volatility controlled index where you won't give up much upside at all, but you will miss the next market correction, so you won't have to wait 5, 7, however many years just to earn that back. Hopefully this was helpful, guys. It's recorded. Listen to it over again. Everybody have an awesome day. Have a great week. Thank you guys very much.